Good morning. I'm very happy to see you all here after very interesting and demanding evening last night, even more demanding morning. There are four elements which make our conference very good and important event that has endured for 31 years. It is, we have very good topic, which is policy relevant topic. Then we bring together policymakers, mostly central bankers, sometimes people from Ministry of Finances, also regulators, people from international institutions, academicians, and people from the capital markets. So we bring them together, make them speak with each other in more formal but also informal ways. So informal things are very important, and this is what makes this conference really great. So this is about the conference. This panel is exactly a small conference within a conference because it has all those ingredients. So we have academicians talking about our work and how capital markets are perceiving it. We have a person from international organization who is discussing how it really works. So it is really interesting. So. Similarly, so the topics today are central bank communication and this kind of choice between inflation and financial stability. They are all very, very interesting. So we will, like yesterday, have two presentations and two discussions, and then we will have floor discussions at the very end. So at the beginning, we will start with Michael McMahon, who is a professor at the Oxford University. He has worked in the Bank of England, so he has this kind of first-hand experience, but then most of his career he worked in academia, but this experience in the central bank helped him how to really understand those issues. So one of his main areas is central bank communication, and you are heading a group on CPR group, Research Policy Network on Central Bank Communication. So it will be very interesting to hear him, how we are speaking, that this issue is very, very important, especially in today's world, which is very hectic and the message is very important. So please, Michael.
Okay, thank you very much. I'll start my timer because I'm almost certainly going to get hit with those cards of stop, stop, stop. Thank you to the organisers for inviting us. I'll give a few things at the start. This is really, I'm presenting an agenda, not a paper, so I have far too many slides. In this talk, I am trying to talk to the three distinct audiences that you mentioned, policymakers, market participants, but also researchers, and so there is a trigger warning. There will be a few equations, but I'll try to keep them simple and guide you through them. Some of the material here is there for anyone who wants to read the slides separately afterwards. And the focus here is on the whole agenda of central bank communication with financial markets. There is an entirely separate agenda that talks about how you try to talk to the general public. I will not talk about that at all in this talk, but if you're interested, please, by all means, come and talk to me. So essentially, the issue that we face, or you face, and we as researchers sort of want to understand, is communication is complex. It combines at least three broad types of news, potentially. That's news about monetary policy, and this is the sort of original, traditional literature. There's a huge amount of work on this. It potentially includes fundamental news, namely news about the state of the economy, and a newer area of research sort of looks at how it can influence or affect either the amount or the price of risks perceived by investors. So in theory, you have these things being communicated, and what's really tricky is you can do them all at the same time. It's sort of not they don't do one channel at a time. You potentially send signals on all of these in one given speech, one given decision, etc. Now, if we want to study this, what we'd really like is more like May 2005. This was a time when the Fed issued a statement but forgot to include a line that had been included in all of their statements for a number of months preceding it, which was that longer-term inflation expectations remain well contained. They forgot to include it. I have not talked to anyone at the Fed who was deeply involved in that, but I imagine it was quite a hairy couple of hours. The Fed, in the end at 4 o'clock, released a revised statement where they had reinserted that line. But you can see that between the announcement and the statement and the revised statement at 4, markets went a little bit wild. So this just shows you the S&P 500 mini futures and the US 2-year Treasury note futures. But it sort of gets you an idea. If we had loads of these, so if we could all agree at this lovely conference that all the central bankers at every statement will randomly include stuff or exclude stuff, my life as a researcher would be much easier. Of course you don't do that, and that's sort of disappointing. But we have still tried to figure out what's going on, exactly with that same idea in mind. This move towards market event studies, and in particular, market surprises, which is part of the title of what I was asked to talk about, is the idea that we can look just before a decision or a speech or a release of minutes, whatever it is, we can look at what the market is expecting. That's the red expectation of the M standing for markets, just before the event of, say, the interest rate, and then we can look at it a little bit after the event, and assuming that there hasn't been loads of other stuff going on in that window, we can work out what the surprise was. Okay? Now, half of the talk, and in fact the talk that the paper that Jari was sent, is really about what that surprise means. There's a sort of really geeky, wonkish question about what we can extract from that, and I'm going to talk a little bit to that to give you a sense of the issues that come up. But I won't today talk about all the econometric challenges and all these other fun things that go with it, because I want to sort of get on to a little bit more of the sort of other aspects of this agenda. But this is the basic idea. By looking at market data before an event and just after an event, we can extract surprises. And then this next 10 or 12 minutes is going to be me trying to think about what those surprises actually tell us, if anything. Okay, but you can see this is from one of my favorite papers. It's Gerkenek, Sachs, and Swanson. They have these sort of plots. You can see there are times when, like at the top one, the market was expecting something, and then as soon as the press release came out at 2:15, the market jumped, and you can measure that surprise, and we sort of think there's something interesting in that. Part of the point they also make is that, you know, if you have an employment release at 8 in the morning, the bottom panel, and then when the open market operation took place, nothing changed, you do have to be a little careful that you narrow your window a bit. The narrower the window, the more confident you are that the only thing going on is the Fed event or the ECB event. But also the narrower the window, of course, you know, you might miss something. So there's a sort of trade-off in there somewhere. Okay. But here's the basic takeaway from this is, there are lots of surprises in the market data. What can we take from those surprises? In this talk, I'm going to sort of ask that question, and I guess the takeaway, if you will, from the first part of the talk is we actually can't take away what the original literature wanted us to take away. And I am of the opinion we can't even take away what the updates to the literature have told us we can take away from it. So I'm going to sort of convince you that these surprises are not necessarily a good measure of shocks for the econometricians out there, but also that they're this is not a technical economics term, they are a hot mess of lots of things going on. And deciphering that is going to take a different approach, and I'm going to show you some evidence for that. And then I want to talk a little bit about, if we think even more deeply about this issue, what world we can get into, and this will touch on some other papers. So, essentially I'm going to go through different assumptions that you can have about who knows what in the world, and then the surprises will take on different meanings in each case. And as I go through this, we're going to get more and more complicated surprise measures. And that's just going to be, from the researcher point of view, challenging, but also instructive for central banks about what to talk about. There's basically 4 talks. So one is the paper, that's the sort of very wonkish econometric piece that Jari actually had to read. He's a perfect discussant for me, whoever selected him. We were talking about this earlier. He didn't know it at the time, but he still hasn't actually signed a contract to say it, but he was inadvertently the RA on that project, and I'll show you how a little bit later. There's 3 other papers that I talk about a little bit. One is joint work with some colleagues at the Central Bank of Ireland, and then there's two papers that relate to my work with Anna Cieslak on essentially how central banks affect risk premium. So I'll hopefully get to those at the end, at least briefly. Okay, I'm going to skip this to say this is for people who want to read this stuff later, but here's what our textbook says about the world. Our textbook New Keynesian model. So we basically assume everybody knows everything. They know all the data, they know the data generating process, they know the parameters of everything, they form rational expectations, so they all have MATLAB and they solve things forward in their head. And we use this a lot to think about optimal policy, what central banks should do. It's a really awful model, as I've said in other places, if what you want to think about is communication. Because all of the interesting communication is baked in. Everybody knows the state of the world perfectly, everybody knows the way it works perfectly, and everybody knows what the central bank does perfectly. The only game in town in this model is forward guidance, because that's deviations from what they know the central bank will do. That's the only bit of communication there can be, okay? You get these beautiful equations, you solve them forward, and you get this sort of world, which is one reason why we think communication and expectation management matter, because the inflation and output gaps today are themselves functions of all these future discounted monetary policy stances of the future. So if it could be a bit more stimulatory, a bit more contractionary, we can do it over time, there's paths, etc. This gave us, where Hugh Pill of the Bank of England gave us the distinction between the Matterhorn and the Table Mountain. In these models, it is exactly equivalent, or you can find exactly equivalent interest rate paths, one that goes up sharply and down sharply, that generates the same amount of cumulated contractionary policy to get inflation back under control, or you can be a little bit tight for a long, long time and get the same effect. Now, of course, in the real world, there are issues. You might think with the Matterhorn, you do too much, you break the banks, you have a financial stability issue. With the Table Mountain, you might think there's some non-linearity that's not in the model, whereby suddenly, because you're not getting on top of inflation quickly enough, expectations start to rise, and then you have to sort of chase it. This is sort of behind the curve type worry. But these models basically have this world where there are lots of interest rate paths consistent with this, gives a clear role for communication. But actually, in this model, there are no surprises. The only surprises should be any randomness that central bankers introduce into their decisions, which again, I'm willing to see that most of you policymakers in the room are not randomly making choices, I hope. Okay, so here's the sort of simple case. I'm going to show this is the key equation. It's very simple, but I'm going to use it a lot. This is what we call a monetary reaction function. Some of you will have called them Taylor rules when you look at the empirical equivalent. It is basically a mapping between a state of the world vector called X, this could be inflation and the output gap in our traditional world, and then the interest rate, and there's some parameters, and these psi vector is the parameters. You can think about this as a weight on inflation and a weight on output in this reaction function. And then there's this nice additive error term, which we call the monetary policy shock. Okay? This equation is absolutely fundamental. The empirical version is what Taylor 93 estimated. The basic idea in this world is that this was an equation that allowed us to put endogenous monetary policy, so have little policymakers in our models to choose which path the economy will be on. That's what the whole point of this is, and I think we have to always remember that. And then in this world, the definition of a surprise is this delta t term, and that's the actual interest rate that the central bank chose, less what was expected of that interest rate. Okay, so that's sort of the definition, and where you ever see E, the superscript Z, that's the market's forecast error of that variable Z, and there'll be a few of those that will turn up. Okay, so let's go to this standard model, the one that I was just talking about, our basic New Keynesian model. In that model, typically we have that the parameters, the psi terms, are fixed, so they don't change every period, there's a fixed value for them, and they are perfectly understood by everyone. as well as that the markets and the central bank and everybody has perfect information on the state of the world. And the only thing that goes on is that those monetary policy shocks are random. They're IID. Okay? In that world, the only thing that a surprise captures is the randomness. And that's beautiful if you are an econometrician, because those surprises then map exactly into what we call shocks, and you can use them econometrically to understand the transmission mechanism, etc. But again, there hasn't been a communication shock, it's just this randomness that is going on under those assumptions. But they're extreme. So let's tweak them a bit. Let's allow for forward guidance. So now the epsilon could be correlated. You could come out as a central bank and say, that's our usual rule, but we're going to deviate for the next 5 periods in a particular way, and you communicate that perfectly. Fine, do all the maths again. The decomposition is now that the surprise is the unexpected part of the monetary policy shock. Still excellent. In fact, if that is what's going on, even more excellent for the econometrician and the applied monetary economists amongst us. Okay? Now let's change something. Let's imagine, and this is part of the literature, let's imagine that we don't all perfectly know the world. But the place we start with this in the literature is to assume the central bank knows everything, and it's just the poor markets who are not quite up to speed. In that world, we can do everything again, and you can see that now the delta is not just made up of the unexpected random part. There's this other part related to X. And we call this the information surprise. And this has been studied quite a lot, and those of you who know the famous work by Jari and Karadi, they come up with an econometric method for trying to purge this out. The basic idea is, sometimes the central bank will raise interest rates, and in raising interest rates, the markets will go, why would they raise interest rates? They would only raise interest rates if they think the economy is better than we think it is. And then the markets go, oh great, we've learned that the economy is even better. And you can see this because things like equity prices then go up rather than down, even though there's been a monetary tightening. In that world, you know, we have a slightly more complicated surprise, but we can still work with it. Okay, let's move on. Are central banks oracles? That's a question. I am, as was introduced, I started my career in a central bank. I spent a lot of time hanging around them. I jokingly refer to myself as a semi-reformed central banker. And I remember what my job used to be. And this is in this paper we sort of describe it. We used to spend a lot of time assembling data, looking at it, probably the same data that Jari and his colleagues assemble in the same sort of spreadsheet format. It's all imperfect, it's all signals, there's a giant filtering problem, and we would run that every quarter or every month to try to figure out what is the state of the economy, and we'd take the data, and sometimes we'd look at it in one way, and sometimes it would be a bit different, but we have this assessment function. And this doesn't exist in our models, because in our models we know the true data generating process. So the data is a sufficient statistic for the true state of the world. In reality, it is not. And central bankers, academics, and markets are all playing the same filtering game to try to figure out the state of the world. Given that, once you have that, then you plug that assessed state of the world into a choice that the central bank policymakers have to make about what the right interest rate is. But this assessment function I sort of take to mean, well actually, I don't think Jari and his colleagues sit there and go, clever Fed, clever ECB, clever Bank of England, they've taught me something about the state of the world. They just learned, oh, that's how they're now assessing it. So if you bring that in where now everybody, so I've highlighted in red the changes, we now have everybody with limited information, and we still have the information surprise us before, but it's no longer that the market is learning from the central bank that what the true state of the world is. They are learning that the central bank is assessing the world differently. And that can be very important for reasons I'm going to come on to in the next few minutes. But I just want to, so there's, econometrically we have the same challenge. The solution has to be a bit different, but also, I think as we go forward and think about this a bit more dynamically, it's going to matter a lot, okay? The last thing to question is there a fixed reaction function? Well, if I go back here, the way we map from inflation numbers to our thoughts on the state of the world itself differs. Sometimes we think the shocks are transitory, sometimes they're more persistent, sometimes we think there's some kind of regulated price that we want to look through. In our models, we map from an observed data into an action. We don't do that in reality because it's noisy and messy. So there is this time-varying reaction function, and in fact, if you do, and there's lots of theoretical reasons why we should have time variation in the reaction function. I list a bunch of them up here. But if you talk to, macroeconomists sometimes, they think, well, it's fine, we can assume we have it fixed and just add a shock. These are actually, this is not an innocuous equivalence mapping. While you can map it, it really messes up both the econometrics and the way the world works. You get different dynamics. So Jari would have been forced to read through all of the technical fun of that. That's in the hardcore paper. If you want it, I'm happy to talk to you outside about it. But I just want to say this is a very dangerous thing to think is an equivalence or something simple. Here's a quote from Mark Carney, which essentially says, look, yeah, it's nice in the models, but they close our models nicely, but we shouldn't expect them to be like these reaction functions to actually describe the world as we make policy. And here's John Taylor himself. This is from the original Taylor-Will paper, where he introduced this empirical estimate. Even with many such modifications, it is difficult to see how such algebraic policy rules could be sufficiently encompassing. They were never meant to close our models. They were never meant to be taken as some guide to how policy is set or some belief that we actually do it. I'll skip some of these, but we also know, we talk all the time in the markets or you see it in the press about how pivots take place, etc. And that's just not accepted in this fixed reaction function rule. Now, once we allow for the reaction function to also be different, this is the surprise. The red are the new terms. Again, I don't expect you to think deeply about that, but this is the mess, right? What we're getting in our surprise measures is how the reaction function has changed relative to what was going on before. Whether there's new information, whether that's new information that we should extract from the central bank, or we've just learned that they're assessing things differently. There's an interaction between these, which builds in a state dependence. There's also potential covariance, which is the idea that you change your reaction function coefficients in certain states of the world. And then, finally, potentially, there is any randomness that the econometrician was hoping to extract to be able to say something clever about the world. This is a mess, okay? Even still, it's fun to ask, well, what do people see? And this is where my very expensive RAs who never got paid came in. What do we do? The exercise is the following. If only we could ask markets whether they were surprised and what aspects surprised them. We can. They make real-time assessments of the statements. And so if you gather enough of these for each decision, you can actually see what they do. So I've assembled a few sets of banks and nearly comprehensive responses to Fed decisions. Any other private institutions out there who have a backlog of this stuff, who want to share it, I'm willing to take it. But you can see some of this. There's lots of stuff on economic reassessment is part of it. There's times when there's no surprise at all, totally consistent with our baseline expectation. There's times when there's preferences. They see that the bar Powell said for additional cuts appears to be quite high. This would mean a few pieces of weak data, blah, blah, blah. When we do it, here's one particular bank's outlook. You can see that sometimes there's no surprise in what they think, but there is a surprise in the data. So we do think there is also unsurprising surprises. If you think there's a reasonable chance of 25 or a reasonable chance of 50, your best guess is 37.5, and you will definitely be wrong because they won't choose that. But there's still information in this world coming from this. We have to try and extract that. That's the point. When we look through it and we try to categorize when they do have a surprise, with this particular bank, we never find a traditional information effect. We never find the central bank being seen as, oh, that's information which I've extracted that I didn't know before. It's mostly assessment function or preferences. There's one occasion in one of the banks where they talk about the senior loan officer survey. I'll briefly touch on it here. the committee may know something that we don't. Perhaps the upcoming senior loan officer survey has very bad news about lending standards. So there could be this idea, but it's very rare what we think about. Instead, you get quite a lot of disagreement. I'm going to use my last 2.5 minutes to talk to you a little bit about disagreement and build on what was talked about yesterday. This puts us in a challenging position. The committee appears to have moved closer to easing, but that would not fit with our forecast, at least based on the committee's apparent long-standing tolerance for such a grim outlook. What does this mean? Well, let's move, and I did this to try and spice it up a bit. Let's imagine that the world does have some heretics. The markets look at the central bank and go, I don't believe them, I disagree, I think they're wrong. Why does this matter? What can we learn? Well, I'm going to skip this just because of time, but you could essentially think there's two things the market can be deciding. One is, what should the central bank do? And the other is, what will they do? And they can be different. So you can perfectly predict someone is making a mistake. And this matters. Okay, I'll skip that. You essentially get to a world where you can have expected mistakes with no surprise, but you think they're digging themselves into a bigger hole, falling further behind the curve. You can have a surprising mistake where you didn't think they would take such an action, then they do, and you think that's going to be a disaster. Or you can have surprises where they undo some of the mistakes. You thought they were misreading the data, and now they've come out and they've interpreted it the way you do. And again, I'm talking about the market like it's a single entity. Of course, there's heterogeneity that's super interesting. But you can get to this world where actually they take a surprising move, but that's corrective. What does this mean? Well, Anna and I have worked on this a lot recently. We have a couple of papers, and the big thing is you can show that the sort of underlying asset pricing, the risk premium, will depend partly on worries about mistakes. Mistakes about economic assessment, and mistakes about the Fed type. And this is sort of yesterday's talk when we were talking about what credibility is. It's a much more nuanced thing. Here you can be considered credible or non-credible in your assessment of the world, or your type, or how you'll react to it, not just the traditional definitions of do what you will say. And I want to just say a few things on that. This is one of my favorite pictures related to yesterday. The green is what we saw yesterday, the expected short rate. The Fed's forward guidance in that new fake world was very credible in the sense that markets believed it. They did not believe they would raise interest rates soon. But if you look way before even 2022, longer term yields, and in particular we show in the paper risk premia, started to go up as markets got more and more worried about the Fed falling behind the curve. And what's interesting about this idea of the dynamically falling behind the curve or making mistakes is that it's not just Fed events that can signal this. It's also macro data that signals it. You can see that between macro events and macro releases, these are in narrow windows. In that period before the Fed pivoted, although short-term rates were held fairly low and not moving, there was a tightening of about 140 basis points that took place in longer-term yields on financial conditions. That meant the Fed wanted to keep the rate low, but actual financial conditions were tightening because the market was increasingly worried or unconvinced that they were taking the right positions. You can see it, you can then measure things like even the Wall Street Journal talks a lot about art mistakes, you can show day correlate with movements in term premia. But then you can see after the Fed pivoted, you can see that even when the macro data kept going in a way that would suggest higher rates, the Fed was now talking a tougher game and signaling a tougher game, such that the Fed events were offsetting the macro events in that period. So let me just take 1 minute and conclude with 6 lessons. These were taken from an RBA paper I wrote last year, but I think they're still on here. Here's some lessons for communication from surprises and more generally. From our models we learn you need to communicate your reaction function, but it's not a fixed thing, so you have to be dynamic about it. You have to communicate the assessment, both nowcast and forecast, and the narrative rationalization of that to be convincing, to have assessment credibility. Explicit forward guidance is overemphasized in our models. It does provide a way to communicate assessment and of the state of the world and reaction function, but if I look at lesson 5 and the experience of the Fed, explicit forward guidance can be constraining, and the appearance of being constrained can build in worries which cause risk premia to tighten and undo your intended policy. You know, the famous quote about monetary policy being 98% talk and only 2% action, people always leave out the next line in that paragraph, which is the cost of sending the wrong message can be high. And then Jeremy Stein's idea, this sort of summarizes my work with Anna, the grip on the steering wheel is not as tight as it otherwise might be when term premia are involved. So you need to take a sort of a framework and communication approach that reflects all that. And the old risk management strategy of Greenspan, I think, still remains sensible to this day, even though he doesn't get credit as a great communicator. The final lesson is monetary policy does require that we manage inflation expectations, but I don't think we should try to micromanage them. I think giving a basic message that we will keep inflation at some level and not try too clever by half techniques like fate that are great in our models, but in practice probably don't work. I've overshot my time, so I apologise and thank you very much.
So thank you very much, Michael. So let's now hear first from Jari the way how market participants saw it, and then we will discuss on the policymaker level after we hear the second presentation. So Jari, please, the floor is yours.
Thank you very much for inviting me to discuss the paper, which I very much enjoyed, and also it was fun to realize that I'd actually contributed unknowingly to that paper over time. So I would like to discuss a few takeaways from the paper and then share some insights that we have generated into central bank communication over time. I think I would highlight three main takeaways from Michael's talk. I think first of all this point that shocks and surprises are different and we need to distinguish between them, I think is a very simple but I think quite important insight given how large literature has treated surprises around central bank events as shocks and have run with them to analyze the implications of that. And I think the point that is conceptually two different things and also empirically might generate challenges, I think is an important insight. Secondly, I think interesting how you've used Wall Street commentary, the comments that we write around central bank events. You find that analysts are often surprised. There is a limited role for informational surprises, and instead the surprises often reflect changes in the Fed assessments, less often changes in preferences. And then lastly, changes in reaction functions are important. It's consistent, I think, with a large body of empirical findings, and you also argue that this actually matters quite a lot in terms of how these surprises or shocks are transmitted into the economy. I think the finding on the absence of information surprises is very intuitive, as you argued. I think it's not very convincing to say that central banks systematically have private information that is revealed. We, in practice, very rarely really think that we're learning something about the state of the economy. I mean, you've mentioned some of the surveys that the central banks run themselves, but rarely would we say that that has really been a key input into the decision. Secondly, I think it's very intuitive to think that reaction functions shift over time. In fact, when you look at some of the recent central bank reviews, the one the ECB has done, for example, there's an explicit role for a state contingent reaction function. As you get closer to the lower bound, you want to respond more aggressively. And so finding that in your assessment is certainly very intuitive. And then I would say that it would be interesting to use your data set to explore how important this distinction between shocks and surprises is actually in practice. So you have, I think, a lot of nice data there, and you can have a look at whether you can use the unexplained surprise in this commentary as a true measure of a shock. You can look at the properties of these surprises. Are they forecastable? Is there a pattern? And then essentially get to the question how severe this endogeneity issue actually is in practice, even though, of course, in principle, seems very much important. And then, in terms of what else you could do with that approach, I think looking at the macro effects of these different surprises, you could, of course, apply this technique to other central banks. You'd be very welcome to use our commentary for that. I think it'd be quite interesting to see how different central banks communicate, whether you find a different decomposition of surprises. And you might want to consider, as you've done, of course, in other work, machine learning tools to sort of speed up the process when you expand this to more central banks. I would now like to share 5 insights that we have generated very much related to all of the work that Michael has done over the years. The first is a simple point, but central banks do often surprise. So what you're looking at here is the average absolute change in long-term yields around central bank meetings for the 4 major central banks, and broken down into changes in long-term yields around the statement and around the press conference. And you find that these surprises are statistically significant. They happen quite frequently. And what's also interesting is that different central banks seem to convey information differently between the statement and the press conference. So you do find quite regularly that the Fed communicates primarily by the statement, whereas the ECB, and especially the Bank of England, seems to reveal more information during the press conference rather than in the statement. So I think that's an interesting distinction. The second insight is that some central banks surprise more than others. So what you're looking at here, if you start at the top left, for the Fed, you're looking at the percent of policy action that is discounted prior to the meeting. So basically the dark bar is for hikes, the light blue bars are for cuts. And essentially the way to read this is that the Fed virtually never really surprises when it delivers hikes. So for all of the hikes were between 85 and 115% discounted going into the meeting. So the Fed does not surprise with hikes, but they do surprise with cuts. So you see that often the cuts were not fully discounted running into the meeting. And so I think there's something interesting going on here. Part of it is probably related to the asymmetry of the business cycle, that you are more often surprised to the downside. Now, if you look at the other central banks, top right, you see that the ECB, the pattern looks very similar to the Fed, so there are also relatively few surprises, a little bit more surprising on hikes. But when you go to the smaller central banks, the Bank of England and then the RBA, you see that the distribution starts to widen, and the smaller central banks deliver more surprises. And you see this. It's not the world's best regression here, but if you plot a measure of the average absolute surprise around meetings against the size of the economy, you see an intriguing pattern, which is basically that the small central banks surprise and the big ones don't. And it's actually quite an interesting question why that is the case, and whether that's optimal for smaller central banks, maybe because they're more open and find it harder to steer expectations in the run-up to meetings. The third insight is that markets often do perceive informational shocks to be revealed at the meeting. So what we did here is essentially what Michael mentioned, use the idea that when interest rates and equity prices move in the same direction, that you call that growth news or informational news, whereas if they move into opposite directions, you call that policy news. And we looked at that around decisions, and you can do that with sign restrictions or simply by scoring instances where you have the opposite sign as growth versus policy news. What you see is basically that between half and 3/4 of the information released is perceived as being policy news, but you see that there's a surprising share that markets perceive as informational shocks. And going back to what Michael said, what I said earlier, I think that's surprising and is not very intuitive. So I think there's something, some form of inefficiency in how markets digest the news, because too often are there informational surprises that are perceived. The fourth insight is that we try to use machine learning tools to analyze Fed communication, see if we could essentially replace ourselves with machines. What you're looking at here, so it's basically we used machine learning to score different documents, statements, minutes, beige books, and Fed speeches. And what you're looking at here is essentially the predictive power of those scored documents for the subsequent policy decision. So it's an R squared here in terms of the information that's contained in those documents. And what's very interesting is that essentially this scoring, this machine learning, works well with the very formulaic documents. So the Fed statement you can read and score actually pretty well with these algorithms, which is not surprising because that's how they're written. The Fed has lists of words that they shift between meetings, whereas the speeches are very hard to analyze with these machine tools. And so when you look at the informational flows, what you're looking at here is how the fit, the R squared, improves as you go from T-1 statement to the statement, minutes, beige book, and then up to the data. You essentially see that there's informational gain with a statement, but then the speeches add very little, and then the data ultimately contains a lot of information. Now, why might that be? And this is my favorite slide, is that we essentially think of central bank speeches as a where's Wally exercise, or where's Waldo for the Americans amongst us, which you might remember are illustrations for children where you have to look for Wally, who's a guy with glasses and a striped shirt. So in other words, it's essentially about finding a hint in speeches rather than really systematically analyzing the speeches. And a famous example, of course, is the whatever it takes comment by Draghi. Just to highlight another one here. At the time when I was working on the US economics team, this was at Jackson Hole in 2012, and Bernanke gave a long speech. We were also thinking, what might this mean? And then there was a hint here where he said, the stagnation of the labor market is a grave concern, which is language that you wouldn't normally use as a central banker, and it was a very clear sign that the Fed was sufficiently concerned with the state of the economy to then launch QE3 a couple of weeks later. And I think these machines will never be able to pick out these whereas Wally informational hints. And then lastly, you also have to be careful with machines in the sense that they can send you the wrong way. And here's an example. In December 2014, there was a big debate running into the meeting whether the Fed would maintain the phrase that rates should be on hold for a considerable time after the end of the asset purchases. And we fielded endless questions from investors whether this would be retained or dropped. Now, what happened was that they kept considerable time in the statement, but inverted the meaning and really changed the outlook very significantly and said they would be patient in beginning to normalize the stance of policy, and that's consistent with its previous assessment that he would be on hold for a considerable time. Now, why is that interesting? Because a lot of people had hedge funds had programmed speech analysis algorithms going into this meeting and had looked for his considerable time in there or not, and the market reaction went completely the wrong way initially because they found considerable time, but the meaning had been inverted. So that's maybe another interesting one to study. And so, yeah, and so to conclude, I think it's not that easy for us to replace ourselves. Thank you.
So thank you very much, Jari, for your presentation. The next presentation, there is one additional element what makes our conference good is to have people come here and repeat the presentation here for many times. And Giovanni Dell'Ariccia is such a person. I think that this is your fourth conference according to my database of arrivals. And it is interesting when you think about papers that he gave. I remember his paper in 2003, which was called Early Birds, Late Risers, and Sleeping Beauties, where he discussed the problems of high credit growth in Eastern and Southern Europe. And also we discussed all the measures that the Croatian National Bank was introducing at that time. Then 2 years ago you were on a panel talking about the danger of high inflation, what to do with this high inflation. So I thought, even though Giovanni would sit on many, if not all the panels at this conference, I found this paper very nice, this how to combine those two possibly conflicting goals very much. And maybe the first paper should come after your paper, giving some of your conclusions, but Giovanni, please take the floor.
Yeah, thank you, and apologies for my voice. I'm nursing a sinus infection, so these are the views of the authors, not those of the fund. Do not try to ascribe these views to the fund. They'll deny any knowledge of my existence, like in the Mission Impossible movies. That, you know, it's the Impossible Mission Force. It's the same acronym as us. So, actually, I couldn't avoid noticing that the academic on the panel didn't have a tie or a jacket, and the private sector guy had a jacket but no tie. The official guy that is tied to this kind of disclaimer has both a jacket and a tie. So it's a measure of the freedom of the individual, an inverse measure of the freedom of the individual. So let me, So let me start by saying monetary policy used to be boring. So before the GFC, I think Claudio gave a very nice summary yesterday. I'm not going to go as deep, but before the GFC, the divine coincidence essentially set to the right of God or nature, if you want, was seen as a sort of an immutable law of physics. I'm making a caricature, of course, but I think there was a lot of consensus in the profession, both in academia and in policy-making circles, that all you needed to do to have a good macro outcome was to keep inflation low and stable, and that would guarantee that the outlook gap would be as close to zero as possible, and nothing would happen. But we knew that was exactly what was going on in most economies before 2008, and yet we were building massive imbalances in the financial sector and real estate sectors behind this seemingly tranquil surface. So post-GFC, of course, the profession did some correction. We started talking a lot about the risk-taking channel, the problems that could emerge even in the context of stable inflation and small output gaps. We started thinking the finance really matter. In models with financial accelerators previous to the GFC, you never really had risk-taking. So that there is sort of like that there are collateral constraints and things like that, but really in equilibrium, you don't have bank risk-taking, you don't have bank failures. Yet, although we recognize that there were these issues, in typical fashion of economists, we decided that, okay, we are on a desert island and we need to open a can. Let's assume we have a can opener. And the can opener here was macroprudential policies. And the idea was, yes, there are issues related to financial risk-taking when inflation is where it's supposed to be, but these are not for monetary policy to solve. These are better done by prudential and macroprudential policies adhering to a healthy principle. There was a separation principle. And so the idea of leaning against the wind, with a few exceptions, Claudio's one, was seen as sort of, I would say, at the margins of the profession. And even at the fund, we wrote a paper where we were saying, yeah, we see extreme situations where leaning against the wind would be advisable, but in most cases, in most calibrations, we think it's better to use other tools. So, post-COVID inflation led to new episodes, and in particular we had financial stresses in the UK, US, Korea to some extent. And luckily, central banks managed to contain these episodes without compromising their commitment to price stability, using non-interest rate tools and other various measures. Yet we think that this is an important discussion to be had. And so we, in this paper, asked the following questions, and I hope I can get to all 4 of them, but I cannot guarantee in 20 minutes. So what is the relationship between monetary policy tightening and financial stress? So we are looking at this from the opposite side of leaning against the wind. In the leaning against the wind debate was, when rates are really low and inflation is really low, that the financial sector will take excessive risk. This is a little bit of the opposite side of the medal, where we say, okay, after the financial sector has taken these risks, and now we have an inflation shock, and now the central banks are reacting by tightening policy rates and real rates, how this financial stress affects the economy, where is it coming from, and how should it factor into the monetary policy decision making. What are the challenges associated with using the can opener? So if we don't want to move the policy rate to deal with financial stress, we need to use other things. These other things are potentially costly, they are potentially difficult to use, and sometimes they're not available at all. And finally, how is the situation different in emerging markets and in general in situations where the central bank doesn't have the years and years of credibility that, say, the Fed or the ECB have. So this is just, I think given the audience this is redundant, but you can think about monetary policy tightening as acting on the financial sector with multiple channels. Here we are listing just some. There'll be lower income, and just lower growth and lower income in the financial sector. There's going to be a higher burden in servicing existing debt. There's going to be lower asset prices. All of this is going to feed into the health of financial intermediaries in terms of credit losses, non-performing loans, lower valuation of securities on their portfolio. If they have a mismatch, like in many cases, at least for banks, that they are short and long, they may have balance sheet effects due to the financial tightening, and this may lead to financial stress. So I'll try to avoid too many equations. This is actually from a different sort of a companion paper, where we look at, okay, empirically, is this really an issue, or was it just SVB? And if you look at the betas of the interest rate expense and the interest income for the banking systems at the aggregate level, country by country, this is the beta relative to the policy rate, so how much the interest rate changes on liabilities and assets when you change the policy rate. You see that most banking systems are very close to the 45-degree line. So at the aggregate level, at least for the banks, there isn't an enormous concern, but then when you look at bank by bank, and this is thousands and thousands of banks across the world, you see that actually there is quite substantial variation around those averages. And in our estimates, it's about 3 to 5% of individual banks, so this can be very small, admittedly, in many cases, that have quite an asymmetry in the way their assets and liabilities react relative to policy rates. And we put SVB there to give you a sense of how extreme it was, but you see that it wasn't alone. There are these risks, at least for marginal players in the banking system. So we built in this paper a conceptual framework to analyze these issues. The two more junior and more tooled up coders actually have a very nice working paper that I hope they'll publish really well, because it's top notch. And on which we base the general framework. And we apply to 4 illustrative scenarios just to give a sense, tranquil times, some stress, a lot more stress, and open financial crisis, and how you react to this. Now, the general take home from this paper should be policymakers should strive to achieve separation between price and financial stability objectives, but it may be that they are unable to fully achieve separation, and the optimal response is going to depend on how severe the stress is and what are the costs of the alternative tools and whether these tools are available. So I'm going, yeah, this thing is a little bit, okay. So I'm going to try to avoid Steve Cecchetti advice against equations. Sorry for the previous presenter. He seemed to think that each equation you lose some portion of the audience is debatable how big. So let me give you my caricature model. This I put together trying to summarize the thinking in a much more sophisticated neo-Keynesian model that my co-authors designed. So this is just think about a positive relationship between aggregate demand and inflation. And then there is also a positive relationship between credit and aggregate demand. So when credit goes up, aggregate demand goes up. There is a negative relationship between the policy rate and credit. So when you tighten monetary policy, banks issue less credit. And finally, you put it all together, you have a negative relationship between interest rate and inflation. And again, imagine a model where inflation operates only through aggregate demand, and aggregate demand is only controlled by the amount of credit. So, super caricature. In this model, if you want to achieve your inflation target by star, you just need to keep the interest rate there at R hat, everything is fine. Now imagine that I have some stress. Here, banks are not as capitalized as they should be. So when I tighten the policy rate, they tighten credit more than in normal times because they are against some capital constraints or something like that. Their assets go down in valuation, capital is lower, they need to tighten credit more, but still in a continuous way. So in this moderate stress scenario, you do not have any problem running monetary policy. You essentially have a tighter financial multiplier. And so the reaction here is just, well, I need to alter my interest rate path, but I don't need to deviate in any way from my policy, let's say from my Taylor rule. All I need to do is that, that is what Powell said in a way after SVB, that the financial markets are doing some of the tightening for us. So the shift from the blue to the yellow schedule means that you only need to get to the yellow R hat instead of the blue R hat to keep inflation to its target. So you see that as long as you have a continuous relationship between the interest rate and credit, really you have no problem here maintaining financial stability and achieving the inflation target. Now, things become a little bit more problematic if you have a discontinuity. Basically, you have a nonlinearity where, and again, this is a caricature, I'm telling you, okay, if the interest rate gets to R hat red, the banking system is a crisis, and credit jumps down dramatically. It doesn't smoothly and in a well-behaved function decreases, but jumps down to 0 in this case. And then you see that you have two choices. Either you do what I did here, where you prevent the banking crisis, but then inflation is going to be above target, or you go above, you accept the banking crisis, and then inflation now is below target, and on top of that you have the banking crisis. So this is the most simple caricature model I could put together to explain what we are doing. And more reasonably than having this immediate jump, you have a situation where you have multiple equilibria. So you have a situation where you are worried that if you bring the interest rate to where it should be to bring inflation to target, there may be a run. And the run, you don't know when it's going to come, you don't know how big it's going to be, and so you don't know if the real economy is going to be on the dotted yellow line or the dotted red line. And so you may err on the side of caution and say, well, I'll take a little bit more inflation in order to avoid the banking crisis. Now, what is the role of non-interest tools like liquidity injections, asset purchases, outright recapitalization of weak banks by the Treasury? Well, The idea is to push the red line toward the yellow line, so you get to the purple line. And if these things are really not costly, then of course you should do it. And then you achieve the separation principle again. If they are very costly, you may only do it partially, and then you may have an interior solution where you use some of these tools, but you also ease up a little on monetary tightening to smooth the adjustment in the financial sector, which doesn't mean that you are abandoning your inflation targeting. You're just saying it's going to take a little bit longer to get back to it because we are concerned about the stability of the financial sector. So this is the summary from the real model. And so think about the very, I hope you can see, the small horizontal dotted line. So the vertical axis I have deviation from the inflation target. On the horizontal one, I have a degree of financial vulnerability. When the non-interest rate tools are completely costless, of course you achieve separation, so you stay on the horizontal dotted line. And it's the same story when you are in the yellow situation that I described in my caricature model. Then if the non-interest tools are expensive, and you have more stress, you can start being in situations like a B1 and B2 dots where you use the tools, but you also accept a little bit of deviation from the target, at least in the short term. Or you could have a situation like the solid line where tools are not available at all, and you have to deviate in a much more substantial way to protect the financial system. Now, there is a situation like in D, where you have an outright financial crisis in which the conflict goes away again. So if you miss the boat and the crisis hits you, it's very unlikely that you're going to have inflation pressures, you're going to have a massive recession, and inflation is going to drop by itself. And at that point, again, you don't have a conflict. In most cases, you don't have a conflict. I would say this is 2008, if you want. So I think the more interesting part of the paper is the one that was heavily influenced by our regulators and supervisors colleagues. And it's the way in which, how do we improve this trade-off? So let's say we are in situations where the trade-off exists. What can we do? And this is about the design of central bank interventions in the financial sector. And in my view, and this is where some of the co-authors disagree with each other, but in my view, it's mostly about preemptive measures. So prudential and macroprudential rules are very useful to avoid a situation where you are in the red line case. I think they are a little bit less useful in pushing the red line to the purple line. Some of my co-authors are more optimistic about the ability of, say, counter-cyclical capital requirements to help when there is financial stress. So, what are the principles? Well, first of all, we take it as given. I think we have decades of literature on budget principles. I think they still apply. I think that intervention should be temporary, should be targeted, should be priced in a way that minimizes moral hazard. There is a tendency these days to focus on market-wide lending to financial institutions. There are a lot of constraints that the reforms post-GFC impose on what central banks can do in a crisis. And these constraints have trade-offs of themselves. So they're probably good things ex ante in reducing moral hazard. In a crisis, they are not necessarily great. In the fact that now you think about the 8% in Europe, the provisions for the Fed of having to lend to everybody rather than focusing on stress institutions. But At least our regulator and supervisor people seem to believe that it's better to provide direct financing to institutions that they intervene with asset purchases. Again, I think it's a matter of splitting hair, but they seem very convinced. So that said, there are a number of challenges in deploying these tools. Like, first of all, I'm of the belief, and Claudio and I had long discussions over the past 20 years on whether it's better to have moral hazard or having another Great Recession or Great Depression. And I've always been, I'll take moral hazard. But I admit that moral hazard is always going to be there every time you provide insurance. I mean, I'm a contract theorist at least by graduate school, and I see contract theory everywhere. When you insure your car, you are more likely to leave it unlocked. If the car is not insured, you're going to be really careful where you park it. And I think this is true of human behavior everywhere, and so we are going to have that problem. I think in the short run, you have a lot of trouble as a central bank in determining, for example, whether an institution is illiquid or insolvent. And generally you have to do this on a 48-hour window before the weekend. The availability of collateral, of valid collateral, is often difficult to ascertain. And there is a stigma in intervening in the market, and there are going to be institutions that are on the edge of being in a crisis or not in a crisis, that are going to be very reluctant to access any facility the central bank is offering, because by doing that, they are going to signal that they are in trouble, and we saw a lot of that in 2008. On top of that, I think that the recent evolution of the financial sector is making things more complicated. There are a lot of unregulated animals, and it's very hard to, as an economist, to entertain the idea that we are going to bail out unregulated animals. Exactly because of the moral hazard problem, with the expectation or promise of a bailout or assistance, there should be strings attached in how you behave. But we don't have, at the moment, a reasonable and wide enough umbrella to cover these new animals. Think about fintechs, think about all sorts of things. There is arbitrage and leakages in regulation. So even for the banking system, now we regulate the banking system, but then they think about who are the holders of COCOs. So a lot of times the holder of COCOs are other banks. If the holders of COCOs are other banks, you cannot trigger the COCOs in a crisis because you are going to exacerbate the crisis. So there are all these sort of problems. And then there is what I hinted at the beginning, is prudential rules are good to restrain financial behavior, but I'm not sure that they are necessarily good in a crisis. So if I cut capital requirements in a crisis, I'm not saying it's not going to help. At the margin, maybe you're going to prevent some fire sales, but you're pushing a string. The banks are trying to tighten, they are trying to come back to solvency, and it's not going to be a panacea. Let me skip for the sake of time. I really want to get to the emerging markets. So it's important to have resolution frameworks that work, and I would say that the recent episodes are both a confirmation that what we did in 2008 to 2012 with the regulation was useful and was not enough. And so we had 2 or 3 major financial stress episodes that didn't turn into 2008, mostly because of what we did in 2008, but central banks still had to take exceptional measures. And if you read the very first page of the Dodd-Frank Act, it has a sentence that essentially is saying we should never be again in a situation to do things like the Fed did after SVB. And we still did it. And I think Credit Suisse is even a worse story, where you have a CFI, which was in theory the Cadillac of regulation, and we still had public funds used in a bailout. So we are, I think, half of the way, and we could do better. I think the use of fiscal policy at times is going to be needed, but it's super difficult, it's slow, it has political economy problems, it has issues in countries with limited fiscal space, and we have a paper, I think, from 3 or 4 years ago, documenting for how long the governments then sit on these assets that they acquire. So I think we wrote the paper in 2022, 2023, and there was still more than 50% of the assets the government acquiring between 2008 and 11 were still in government hands. So it's a long shadow of financial or public sector intervention in financial systems. Now finally, I mean, I'm at the fund, so we have a global membership, and you talk to somebody from an emerging market, and they say, "Hey, all this story you're telling is super interesting, Giovanni, but it really doesn't apply to me. It may be very well for the Bank of England, ECB, or the Fed to say, oh, we provide liquidity when you have financial stress. If I do that, I have a run, not just on the banks, I have a run on the country." And that's what they get. So when you have lower central bank credibility, you have poorly anchored inflation expectations, you tend to have large exposures to exchange rate risk. And you tend to have a situation where when you have a banking crisis, because of the sovereign bank nexus, people don't just run the banks, they run the country. So if you have a problem at SVB, I should have put it here, that I have an email from a friend that is an investment banker, and his bank had SVB as their main bank. And I think because he knew, they got out early. But a lot of their clients didn't get out. And so he sent his email on the Thursday of the crisis saying, from Monday, every cent, and I mean every cent, not used for working capital, is going to be invested in 6 months treasuries. And I think every treasurer in the US was doing that. And that's why the Fed did what it did to deal with SVB. In an emerging market, people are not going to buy local treasuries when they run the bank. They're going to buy US or Euro treasuries. And so you have a problem that you have a run not just from the banking system, but a run from the country. And this complicates the picture enormously. So everything I discussed with my little pretty lines and dotted lines goes down the drain. And essentially you go into what we call an IBF scenario, where you had to use much more draconian tools. You may have to impose capital controls, you had to use foreign exchange intervention in various ways. And again, macroprudential measures and releasing buffers is going to help a little bit, but at the same time, think about what you're doing, right? Think about the signaling, and this goes a little bit to the communication discussion that you had in the first paper. So you know that there is financial stress, you know that people are concerned about the health of the banks, and now you're telling, oh, but we are going to let the banks run down their capital. And people say, oh, that's really a great idea, well, the banks are in trouble. And so there is an element of something that in a model with perfect information and perfect foresight works very well, but in a model where information is much more bundled together may not work at all. And I think I'll stop here. Just the last thing I wanted to show you, we have a lot of cases described in a qualitative way in the paper, which I thought was a great contribution of some of our co-authors. So you go from the saving of loans to easing in the global financial crisis, the regional bank crisis in 2023, but also the Nordic crisis, financial stress in the euro areas, the Turkish financial crisis in 2000-2001, that I think is the best example of conflict. So there in our program, we were actually fighting inflation very well at the beginning, and that there was a constraint on essentially on money printing. And then the banking crisis came, and the Bank of Turkey had to choose between keep the money printing down or providing liquidity to the banks. And you can really see like it's a V-shaped thing. And inflation is coming down, money printing is coming down, and the crisis comes, and they start providing liquidity to the banks, and everything in reverse. And that's where fiscal resources are useful. That is where the IMF program came with dollars and sort of fixed that trade-off. Thank you.
So thank you, Giovanni. It is quite interesting, and I think that our example of not having a crisis is also a good case study to include in such places, because it is always most interesting when you don't have a crisis, what has happened. So our new colleague Ivo Bakota will discuss this paper. Ivo, please. Thank you.
So I'm very grateful for this opportunity to discuss this important paper in front of distinguished audience. Unfortunately, right after the amazing dinner last night, but okay. So the views expressed don't necessarily reflect the views of the bank. I don't have a tie today. I leave to Giovanni to interpret what that means. So I really enjoyed reading the paper, and I think it's one of those papers that after you read it, you get some clarity, and subject matter seems kind of intuitive. So kind of the underlying idea of the paper is that tightening of monetary policy can lead to financial stress in times of high inflation. So in times of low inflation, the goals are mostly aligned. So I have a question mark here, because also some financial vulnerabilities can be accumulated during long times of low rates. But the times of high inflation are the interesting case, because there might be some trade-offs between price and financial stability goals. So we want to avoid these trade-offs by achieving separability that Giovanni was talking about, and that can be achieved by employing these other tools, but not always. So the contribution of this discussion note compared to some earlier IMF blogs is that it really provides more theoretically grounded and granular policy recommendations. So when I was reading about these trade-offs in the paper, it immediately reminded me of the recent paper by Karadi and co-authors, who claimed that central bank should strike the iron while it's hot, so meaning in times of high inflation that central bank should be even more aggressive in fighting inflation, because the Phillips curve tends to be more steep, and the sacrifice ratio in terms of output when fighting the inflation is lower. So of course they don't consider the effects on financial stability, but I think these results really pinpoint to how important these trade-offs are that are discussed in this paper. So I like this graph, so it captures this idea that if there's no stress, central bank wants to set interest rate high to fight inflation, but in case there is stress and the separability is not perfect, then it should set this interest rate lower than it would otherwise want to. So how much lower depends on the degree of achieved separability. So in my time for this discussion, I want to give a little bit of context by citing some relevant academic papers on when this stress can arise, and also give some details on the latest tightening cycle in the Eurozone when there was not this big instability. So here on this graph, we can see some of the historical episodes of this systemic stress and inflation. So in the lower right corner, we see the great financial crisis, where we had a high stress, which we can see on the x-axis. We had KISS, which is a measure for short-term systemic stress, and on y-axis we have inflation. So we had high stress but low inflation. In 22 we had potentially a varying case where short-term stress was high and inflation was high. But this stress did not materialize into instability. And now we are in a lower left corner where we want to be when both inflation and stress are relatively low and close to the target. So now I want to mention some of the academic papers which deal with the question of when can this tightening, when is it likely that it will cause stress. So this paper shows that, at least in the US, it's more likely that tightening will cause stress if the inflation that the central bank is fighting is caused by supply-side shocks rather than demand shocks. And basic intuition is that in the case of the supply-side shocks, companies tend to have bad cash flows, which are then made even worse by tightening. While in the case of demand-side shocks, companies tend to have good cash flows, which then act as a buffer against high interest rates. And here, monetary policy tightening can have even slightly beneficial influence on the financial stability because it makes asset price bubbles less likely. So another case where the tightening is more likely to cause stress is when it's following a long period of low rates and we say a low for long rate period. And the interesting case is that both of these were present in the latest tightening episode, and still we didn't see big financial instability. With the supply-side shocks, it's a bit more complicated because there was more combination. There was also talk of some microeconomic phenomena aiding in high inflation, such as sellers' inflation. But nonetheless, both were present, and there was no instability. And of course, big role was played by the ample liquidity that was present in the system. So here I also want to show that tightening under certain circumstances can be even good for banks in some respects. So for example, profits of the banks in the latest tightening cycle rose. So here we see return of equity increasing. So the big role here was played by the ability of the banks to keep the rates on deposits low, so also known as deposit franchise. So here I also show net interest income that rose, and in the black you see the direct remuneration that the banks got from the euro system for their excess liquidity. So these are return on assets, which also increased. And here we see that there was a heterogeneity across the eurozone, across different countries. And it's interesting to see that the big economies, so France and Germany, had the lowest return on assets. So the banks, their banks had the lowest return on assets. And one can look at this as another potential source of heterogeneity in the monetary union. So in the end, we can say that in this particular tightening cycle, there were two counteracting effects. So the first effect was that profits of the bank increased a lot. But on the other hand, the balance sheet of the banks was weakened. So the economic value of equity also fell. So also the banks had big unrealized losses on the bonds that they were holding because they got discounted more with higher interest rates, and then a lot of banks moved those assets and bonds from their for-sale portfolios to their hold-to-maturity portfolios. But it's a question, for example, if they would be hit by another big shock, if they would be really if it would be really possible for them to hold these assets until the maturity. And of course, as I said earlier, the big role why this was possible, this tightening with no big instability, was the role of improved liquidity that was in the system, but it also has some side effects like rising asset prices. So in the end, I would like to conclude with posing a question if you can know beforehand which of these two effects would dominate before we make another tightening cycle. So that's all from me, and thank you for your attention.
So thank you, Ivo. For the sake of time, we started a little bit later, so I suggest that we take 3 questions, and then we have authors respond for both, or two questions and discussion, just for the sake of time. So maybe to start here with Steve, Bill, and then Athanasius. Are you okay? Athanasius, you can start.
Linking in a way the two, is there a concern that because of more central bank communication, central bank officials, they are kind of like celebrities, and instead of being popular or boring, they become too popular and actually like it, and they are reluctant to remove the punch bowl. So maybe when they ease, they respect the separation principle in theory, but then they don't take enough macroprudential measures because they are popular. And when they hike, they are more concerned that something may break. So maybe implicitly they don't respect the separation principle. Now, you can say if this was the case, we'll have even more financial shocks and crises, which you can argue we have. And you have high inflation, which maybe we have not seen this so far, because in the low inflation era, inflation was low for things that have nothing to do with monetary policy, which might not be the case now. But are you concerned that we may have this kind of a problem?
Question for Jari and then Michael. Really on the mother of all your regressions. So you had size of the economy on the horizontal axis, but it struck me that openness could also be there. And so the question is, there's a variety of hypotheses that you can make where sort of the problem is coming from. One is that those economies that have more uncertainty and more sort of interpretational mistakes are simply more open, and therefore we have a harder time with it. Even the central bank has a harder time grappling with that. The other one would then be sort of on a more meta level, whether we have enough resources and dedication to analyze those economies, as in the market, or whether we have enough dedication to analyze what the central banks themselves are saying. And, because we don't do it 100%, we remain more surprised. So I was curious whether either one of you had a suspicion as to where that inverse correlation is coming from.
Steve.
Thanks very much. Excuse me. Yeah, thanks for 2 very, very nice presentations. I have a question maybe for Michael and Jari both. So the first question is a sort of big picture question, which is, why do I care at all about the shocks? The shocks are tiny, and they potentially involve trades among people in the financial system who I frankly couldn't care less about. Because I don't really care who wins at the poker table of the hedge funds and the large banks. I realize a lot of people here spend their lives worrying about that, so I apologize for the implicit insult. But there's a second part of that, so at some level I'm wondering why I care. But then there is a part that I do care a lot about, and that is that I've always wondered about whether communication by central banks involves shifting wealth from uninformed to informed people. So that's where what I do is I look around the room at all of you who operate in the markets and worry about this, and I say, you're taking money from people who don't understand what's going on when interest rates rise. Because remember, what we're talking about is fixed income markets, which are inherently zero-sum. Okay? So I'm just trying to figure out what's the responsibility of the central bank, in the first case, why they care, and in the second case, should they worry about these wealth transfers that they're generating between uninformed and informed people? Thanks.
Thank you. I suggest that we go now with answers and then take another round of questions.
Okay, let me thank Jari. Great discussion. And just to comment, Giovanni, I have a jacket. I just couldn't wear it. I'm physiologically built. I'm Irish. I'm physiologically built for the cold. And even in an air-conditioned room, I will melt with all these lights. Please on.
My comment was more about envy than criticism.
No, just so people understand. So I'm gonna jump around a little bit because I can answer and respond to some. So one of the striking things, you know, Jari showed his chart. Like, there's a whole academic literature that does similar things about these what you call growth shocks. The academic literature calls information surprises. And I think what I was trying to get across is that essentially how you interpret them depends on what you're willing to accept as, well, who knows what and what's going on. And so one explanation for why equities go up when decisions are made is, I think it's important that we realize that inflation volatility is not good for equity markets, right? So a central bank that credibly looks like it's going to fight inflation, and yeah, it's costs today, but the future could be better. And that's ultimately the dynamic game that central banks are playing. They're trying to take actions today, but the future, keep it anchored around some sort of stable point, low inflation, natural rate of unemployment. Some of what could be going on with the equity price is risk premia. And so thinking about that and decomposing that out then gets you a little bit. And this lets me get a direct answer to Steve. I have two answers about why I care. And just as a slight comment, I don't think your insult was implicit. As soon as you said it, it became explicit. But anyway, I don't know the answer to whether we're shifting wealth from one group to another. And I'm sort of with you in the sense that I don't care. I've said this many times. I don't think central banks should worry about markets moving, so long as they move in the direction they want. Okay, so let me tell you why I care from an academic point of view and a policy point of view. From an academic point of view, I think it can help us answer questions that are important. One is, can we understand the transmission of policy and what matters for that, and what state contingencies and stuff like this? These are important questions. To answer that, we need something that econometrically lets us answer those questions. We've started using surprises, and I think we might be going down the wrong path because I don't think they're exogenous, and so we need to be careful about that. The sort of more policy-relevant reason I care is because I think it matters how we design communication strategy. As I sort of tried to allude to, our baseline model that we use for optimal policy essentially has no communication advice in it. It's all baked in, and we learn nothing about how we design communication from that. So we've got to look somewhere else. And so this does, potentially help guide central bankers who are talking a lot, and I'll come eventually onto whether they're being too popular or whatever. I don't really know my answer to that. But it sort of then gets to this question, and I'm going to add a third one to address the point about why we might get less surprises in some places, and that could be within policy. They could feel constrained to not surprise markets. You see this in transcripts where they go, well, the market's pricing this in, we couldn't possibly move now, we'll have to send a signal that we're going to move, and then we'll move. Again, if we have a strong belief that the rate is 25, 50, 75 basis points away from where it should be, I'm in the zero-sum game insult world where, just do it and tell them and explain to them. But I think what I take from a lot of my own research and looking at these, thinking more deeply about risk premia and mistakes, is that this concept we talked about yesterday of credibility has to come into it then. And what it means as a communication lesson for the policymakers is you've got to be credible in lots of aspects, including how you assess the world. So maybe one reason why this isn't done is uncertainty. So why don't they just come out and say, well, we've done our maths and it says we should raise by 50 and we're doing it. I know you didn't expect it, but there you go. And there is this asymmetry. It's apparent in the data. Most of the surprises that we look at are from the downside. In that the market was expecting maybe minus 25 and they go with 50 or 75. Why? Because in a recession, nobody gets angry that you oversaved the world. I think they do worry a lot more about, you know, this slow-moving asymmetry of the business cycle. You don't want to do 100 basis points suddenly because you think inflation is coming. You do it 25, 25, 25, 25. I don't, so there's not an answer to the question. I think there's lots of reasons why they could be going on. I don't know if they're trying to be too popular. I know plenty of central bankers who don't like all the limelight, but it's now a necessary part of the job, and I think it's very, very difficult. It would be very difficult for them to start uncommunicating again. You know, going back to the kind of never apologise, never explain Montague Norman view of the Bank of England. But yeah, I don't know. I do know that, you know, so for example, fate. Some of the stuff with Anna, what we show is that, this is what I talked about, risk management. One of the big policy design features of fate was to become less preemptive against inflation. So this was the Fed's internal worry that inflation expectations would become anchored below their 2% target, and so they would allow for overshoots. And to allow for overshoots, you have to not be as preemptive as possible. And one of the slides I have, you can see from their own risk assessment, they have this risk diffusion index. That goes way up to worrying about inflation, and they don't change their forward guidance at all for about a year. That's an active choice. That was not the risk management preemptive policy approach of the refund. But that was baked in because they saw a problem that, well, I guess ex post, either because they were unlucky or because we've learned a lot. I don't think what they worried about was the right thing, but they were really concerned about this low R star and the fact that we'd get anchored in this low inflation expectation world. But the market wasn't worried about that. So I advocate going back to more preemption, and central bankers should absolutely be happy to be unpopular.
Giovanni,
yeah, well, let me thank Ivo for the nice discussion. I think a lot of your data points are super interesting, and maybe we should have, you know, an update of our charts where we talk about those episodes. I want to touch on two questions. One is on Steve's question, even if it wasn't directed to me. I think you do care on, I mean, maybe you don't always care who wins and who loses, but there are days in which you care exactly because of financial stability reasons. And so if you know that with a certain move you are going to cause a massive problem, say in the hedge fund industry that is levered up and has exposure to the banking system and, you know, all sorts of cascades, you may be careful about that. Now, whether you should be in the situation to start with is a different story, and this is a segue into Tano's questions. And let me cite, out of respect, Stehn Fisher. And when he was governor of the Bank of Israel, he used to tell this story. They were like pioneers in macro-proof, with loan-to-value ratios, loan-to-income ratios, things like that. And he was saying, when we are concerned about the real estate sector or household sector indebtedness, we tighten these ratios and we get crucified in the press because we are killing the young couples that try to start a life together. And then, of course, the crisis doesn't come, and the crisis maybe doesn't come exactly because you tighten the LTVs. And then a year later, people crucify you again, saying, see, you were paranoid, and you impose all these costs on society that you didn't need to impose, which is a very, and this is, I think, is the curse of prudential regulation, in particular of cyclical prudential regulation, which is very different from monetary policy. Because in monetary policy, you're going to point to the inflation rate and say, see, we are at 195, and if I had not tightened, we would be at 3. So next time, before you crucify me, think about it. And instead, because of this 0-1 observation problem that you have with financial crisis, maybe you do exactly the right thing, and then you are crucified for doing the right thing. And I think that generates a bias. And I sympathize with you. I joined the fund at a time where if we were in the press, it was because we had done something wrong. And otherwise we would be this obscure agency that nobody knew about. And now we have a communication department that has a budget and a head count that is bigger than my department. And so I'm not sure that there is a way to go back. So stop there.
So two very brief questions. We were to the gentleman in the back, if there is still a question. Yeah, Professor Beck. Yeah, please.
There's a question directly to Giovanni. You set up your discussion as a conflict between price stability and financial stability, and yet when you talked about emerging markets, you introduced the possibility of stress on the country. There was a period, not just for emerging markets, when there was a discussion of fiscal dominance. Should you include that in the model somewhere?
Thank you. And Brigitte, the last question before the coffee break.
I'm sorry, it's not a question. I just wanted to support Michael and talking from a central banker perspective. I mean, on Steve, it's not about who is winning, it's about the transmission of monetary policy. Yeah? So we don't want to surprise or shock markets, because that means that we cannot effectively say where we are going, and we have been suffering from exuberant markets undermining the monetary policy of central banks. Yeah? So that's a very important point. To have clear communication and not going back to the 19th century is, we are accountable. And you have been talking about the communication part for the specialists sitting here in the room. But we also have to, with our concept of layer communication, make ourselves understandable to households and firms. And that's the real challenge. And the teaser, I hope that the media doesn't read it already, but exactly in our strategy review coming up this summer and autumn, we will provide food for thought on what Michael has been saying, that by clarifying the reaction function, you diminish the surprises.
Thank you. So very brief answers.
I think that's a point well taken. I think that's the other potential trade-off, and let me be more careful of what I said at dinner the other day. I think that there are very, very few episodes in history of countries that issued debt in their own currency and control the money supply where there was a restructuring or a default. And essentially is endogenous fiscal dominance, where if the sovereign gets in trouble, it's cheaper at the system level to inflate it away than to have an outright default. I think the 2011 crisis in the euro area is a specific case where there were countries issuing in their own currency, but they were not controlling the money supply. And so you go back a little bit to the emerging market story. So if you think about Greece debt in euros, from this point of view, is more similar to, say, dollar debt in an emerging market than local currency debt. And I think, again, it's one of the situations where you don't want to be, and where the measures that you should take ex ante are much more effective than the measures that you can take ex post.
So thank you very much. Let's give a big applause for all